So guys, one of the biggest pushbacks you'll hear against dividend investing is that dividends aren't guaranteed. You'll hear people say this all the time. And you know what? It's true. Even though companies set dividend policies and try to stick to them, the reality is they can change those policies at any time, which means that unfortunately dividend cuts can happen at any time. The thing is though, they usually don't come out of nowhere. Usually if a company is going to cut their dividend, there are some warning signs, some red flags that show up beforehand. And in today's video, we're going to look at 3 stocks where I'm starting to see exactly that. These are 3 companies that, based on what I'm seeing right now, could be next in line to cut their dividends. Now guys, stock number 1 on our list today is going to be Whirlpool, who as we can see is just having a terrible year so far. The stock is down almost 28% just here in 2025. And if we zoom out over the last 365 days, Whirlpool is still in the red. The stock is down 3.1%. And if we look at the snap score right here, we can see that just based on this, Whirlpool is looking to be a very below average company. The snap score is only 2.35 out of 10, and they are scoring very poorly in pretty much all categories, with the exception of dividends and buybacks, which is actually getting an 8 out of 10, which is kind of interesting, but below the surface here, it's not as good as it's cracked up to be. Now, first things first, scrolling down, taking a look at Whirlpool's growth metrics. Over the last decade, this company's really been at a steady decline. We can see that right here in the revenue. The sales have gone from about 21 billion in 2015 to now being at 15.8 billion, basically 16 billion in the trailing 12 months, and that is a pretty steady slope downward. And then looking at the earnings per share, at best, I would say that this is inconsistent. There were some good years, I'll give them this. 2015 to 2021 looked pretty solid for the most part, with the exception, obviously, of 2017 and 2018. But if we exclude these years, the earnings growth was pretty solid and consistent for this stretch of time. But then something happened in 2021 where the earnings per share really took a big hit and just has not recovered. In 2022, they took quite a loss in net income here. The earnings per share was negative. Back up again in 2023, but still this 2023 number, $8.75, was below what they were generating almost 10 years prior. So that's not great. And then the earnings per share was negative once again here in 2024. But then looking at the free cash flow per share, this tells a little bit of a different story than what we saw with the earnings per share. Once again, 2015 to 2021 were some pretty solid growth years for the free cash flow. But then after 2021, basically this next year until present, the free cash flow per share has been at a steady decline, which obviously doesn't bode well for the dividend. If the company's not able to generate net income, if it's not able to generate free cash flow, or if that free cash flow is declining, it's going to be pretty difficult to maintain a steady dividend throughout the years. And we'll take a look at the dividend stats in just a moment. But first, I wanted to take a quick peek here at the debt, because to me, this looks like another red flag for Whirlpool. We can see that the debt really jumped up here in 2022. It actually doubled going from 2021 to 2022, more than doubled even, and it's been pretty high ever since then. And then along with that, the net debt to free cash flow has been left in a pretty poor spot. I mean, after that big jump in debt, it went from, 1.8, which is very sweet. That's a very solid net debt to free cash flow ratio. Just the following year, it went up to 7.6, which is still a bit high for my liking. I think that for a company like this, a net debt to free cash flow somewhere around 5 to 6 or below is pretty reasonable. I think that's what you should be shooting for. And then generally speaking, the higher you go, the more sketchy it gets. And as we can see, that's pretty much what happened here. The following year, the net debt to free cash flow jumped up to 17, which is crazy. And as we'll remember from the growth chart right here, the free cash flow really took a big hit. So it's no surprise to see that net debt to free cash flow on the up and up. And then in 2024, pretty similar story, a very high net debt to free cash flow. And with this jump in debt, with the decrease in free cash flow, simultaneously, the interest coverage has been declining as well. So all across the board, the debt situation just seems to be getting worse over time. And then getting into the good stuff, looking at the dividend stats, the one redeeming quality that we're seeing here with this company is the dividend yield. Now, you might be looking at this thinking, or you might have researched this company thinking, man, an 8.4% yield, give me a piece of that. But I think everything that we've seen leading up to looking at these dividend stats is a great reminder of why you have to look beyond the dividend stats. You really need to take a look under the hood at these companies, because there is so much more to analyzing an investment, especially a dividend paying stock, than just the dividend yield. You really have to look at the whole picture. So once again, a very high and juicy dividend yield. And I will say, for the most part over the last decade, it's been a pretty solid dividend grower as well. The 5-year growth rate's looking sweet. The 10-year growth rate is looking sweet as well, high single digits in both departments. So I think that's really looking good. But that dividend growth has really leveled off for these last couple of years. It's been $7 per share since 2022. And I think this company really got itself in a sticky situation when it made this substantial dividend increase going from 2021 to 2022. In this year right here, they increased the dividend about 28%, which is an insane amount to increase the dividend. If I was a shareholder, I would have been jumping for joy. If any of my companies increased their dividend by almost 30% in 1 year, yeah, I'm pretty stoked. And what I think happened is Whirlpool got a little bit ahead of their skis. They had a really solid year in 2021, okay, both in terms of earnings per share and free cash flow. Both were considerably higher than the prior year. So I think they were feeling a bit minty, feeling a little bit overconfident going into 2022, and that's what prompted that substantial dividend increase. But as we can see, 2022 turned out to be not a great year. Okay, they lost money in the earnings per share, the free cash flow per share took a big hit. And once they made this crazy increase, I think they realized they really didn't have the cash to back that up. They couldn't continue to increase a dividend after that point, as we can see here. This is why it's been stagnant since 2022. And if we scroll down looking at the payout ratios, obviously they lost money in 2022, so the payout ratio is going to be negative. Not great. Going into 2023, where they did bring back a little bit of positive earnings per share, but once again, the earnings per share that they generated in 2023 was even lower than what they brought in 2015. So still pretty high payout ratio in 2023. 2024, since the earnings were negative again, the payout ratio is also going to be negative. But free cash flow was positive all those years, and during this time, we really see the free cash flow payout ratio getting into a pretty sketchy situation. In 2023, it jumped up to over 100%. In 2024, it's also over 100%. And it looks like in the trailing 12 months, it's kind of started to come back down, now sitting at, 66%. But we'll see how the rest of this year shakes out. There's a lot about Whirlpool right now that I'm just really not liking what I'm seeing. And obviously, I have no idea whether or not Whirlpool will actually end up cutting their dividend, but I am a bit concerned by the direction some of these stats are heading, namely the growth, the debt, the payout ratios as well. And so all of that's to say, I will not be buying Whirlpool anytime soon. I'm a bit concerned about it, and I'm interested to see what happens with the dividend moving forward. Anyway, my friends, this is going to bring us to stock number 2, which is a company that I don't believe I've really talked about before on the channel. This is Dow Inc., ticker symbol DOW. And like Whirlpool, they've had a pretty poor year. Just in 2025, the stock is down 27.5%, and over the last 365 days, it's seen an even bigger drop. It is down almost 50% just in the last year. And like with Whirlpool, we're also getting a very low snap score here, although this is a bit higher than what we saw with the last one. But still, the snap score is coming in at 3.6, and for the most part, they're scoring pretty low in all departments. The debt situation does look a little better. We'll take a look at that in just a moment, but growth is low, profitability is low, dividends and buybacks is a lot lower than what we're seeing with the last one. And so overall, not great scores on the surface, but let's scroll down, taking a look at the growth stats here. Now, starting here with the revenue, I would say that at best, this has been steady. Okay, it doesn't seem like there's been a whole lot of overall growth in the sales over the last decade. We do see some spikes here. 2018, 2021, 2022, we do see a little bit of uptick here in the sales, but it's not been a consistent thing. There is definitely no consistent growth here in revenue. And actually, since 2022, every single year since then, so really these last 3 years, the revenue has continued to decline, going from actually, this is a pretty substantial decline, going from $57 billion in 2022 all the way down to $43 billion in 2024. And along with this, no surprise, we're seeing a very similar trend here in the earnings per share. Very spotty, very choppy earnings per share over the last decade, but really since 2021. Kind of like we saw with the last stock as well, the earnings per share has just been in decline over these last few years. And once again, same thing with the free cash flow per share. Since 2021 or 2022, actually, it's really just dropped off a cliff. Okay, to the point where in recent times, it's actually dipped into negative territory, and that definitely does not bode well for the dividend, because companies pay out their dividends from the leftover free cash flow at the end of the day. So if a company's not generating any free cash flow, it's not going to be able to sustain the dividend. And scrolling down just a little bit, taking a look at the profitability metrics, so just looking at the margins, one of the big things I noticed with this is that the gross profit margin has been at a steady decline over the last decade. This is actually a much greater downward slope than we saw here with the revenue, which tells us, guys, that with this stagnation or even slight decline in the company's revenue, they haven't been able to lower costs to offset the drop or the stagnation in the revenue. So the company is actually becoming less profitable over time. And in fact, if we look at these margins, I mean, it looks like the costs are increasing. If the revenue is staying stagnant, but the gross margins are declining, that means that the cost of goods for this company is actually increasing. So it's becoming more expensive to operate this company over time. Anyway, guys, scrolling down, looking at the debt situation right here, we're not seeing as big of a jump as what we saw with Whirlpool, but since 2022, Dow has taken on consistently more debt, going from about 13 billion in 2022 to now 16.5 billion. So not a crazy jump, and also not the highest amount of debt that the company's ever seen. In 2018 and 2019, it was a bit higher than where it's at now, but still it is on the up and up. But with this, I will say that historically, the net debt to free cash flow has been in pretty good shape. Once again, the number that I try and look for is maybe about 5 or 6 or below. And in 2023, which looks to be the highest that it's been in recent years, it was 4.95. So it still is within that threshold for us. And then because the free cash flow is negative last year, obviously we're getting a negative net debt to free cash flow as well, which is not good. And then along with this, the interest coverage, as we can see here, has been declining pretty steadily as well. And in 2024, it's only 2.35, which is, I will say, not very comforting. So with that, there are a handful of red flags with Dow, and we haven't even gotten to the dividend stats yet, but I think looking at the stats here, you guys will see how it's starting to get a bit dicey for the dividend. So right off the bat, the first thing you'll notice here is this dividend yield. Now, once again, we're getting a very high, a very juicy dividend yield, 9.8%, which on the surface might have you seeing dollar signs, but kind of like we were explaining just a few moments ago, there is so much more to look at, and we've seen some not great stuff so far, and I would say that the rest of the stats beyond the dividend yield are not great. Even though the dividend yield right now is incredibly high, the dividend growth has been stagnant now for the last 5 years. It stayed at $2.80 ever since 2020. And during this time, the payout ratios, I think, have not been in great shape. Starting here with the earnings payout ratio, in 2020, this was 170%. And in fact, it looks like the earnings payout ratio has been over 100% more often than it's been under 100% in the last 5 years. 2021 and 2022 didn't look to be bad years. We're getting, mid 40% range at most, but then it really spikes back up in 2023, over 300%. They're paying out over 3 times as much in dividends than they're generating in net income. That's crazy. And then in 2024, once again, a 176% earnings payout ratio. So not great. And then the free cash flow payout ratio, admittedly, for the most part, has been pretty solid since 2020. Okay, at most, it looks like it was mid 40s, so still in pretty good shape. But then it starts to get a little bit higher here in 2023, jumps up to almost 73%. Still some wiggle room here, but definitely not as much as the prior years. And then in 2024 is when it starts to really go downhill with the negative free cash flow. Look at that payout ratio. That's pretty poor. And even so far this year, Dow is not off to a great start with the dividend. I mean, in the most recent quarter here, they're still paying out considerably more than they're earning. It looks like they paid out almost $500 million in dividends for the quarter, but only generated about $100 million in cash from operations. So that obviously doesn't bode well for the company or for shareholders at all. And from the looks of it, a lot of shareholders are concerned about the dividend safety as well, and I don't blame them. It's getting pretty dicey for Dow. But anyway, guys, now moving on to stock number 3 on our list today. This one is going to be Weston, ticker symbol LW, which is a pretty interesting business, I think. They're a producer and distributor of frozen potatoes, which is a very simple and straightforward business to wrap your head around. But as we can see, the performance has been pretty poor so far this year. They're down 13.9% here in 2025, and over the last 365 days, they're down even more, down 34.4%. With that, though, it looks like this is going to be the highest snap score of the day, and according to this, at 6.15, that's going to make Weston an above average business. And looking at the breakdown here, the growth stats are, pretty middle of the road, 5 out of 10. Low profitability here, which may not be too surprising considering the nature of their business. So that probably just comes with the territory. Debt situation looks pretty good based on the score. Dividends and buybacks looks great, 8 out of 10. We'll see what's going on here. Capital efficiency looking really good too, so strong returns. But let's take a look under the hood, guys, and see what we can dig up here with Weston. So starting here with the revenue, I've got to say I have no qualms with this whatsoever. The revenue growth has been consistent. It's been aggressive, more so in recent years. It looks like the 5-year revenue growth rate is 14.3%. And even over the last 10 years, it's been solid 9.2%. But then it starts to look a little different here in the earnings per share. It's kind of, it had a nice uptick here leading into 2020. And then since then, it was downhill. And then a nice big old spike here in 2023. It really jumped up and also was higher than average in 2024, still below 2023. But this looks to be, kind of an anomaly for the company. And then looking at the free cash flow, there's some good, there's some bad, some up years, some down years, but it looks like really since 2021, the free cash flow has struggled. It really dropped off a cliff in this next year and even dipped into negative territory in 2024. And then scrolling down, looking at the debt situation here, clearly we can see this company is just levering up their balance sheet. In 2021, the net debt was less than $2 billion, just under $2 billion there, and it's more than doubled. In the trailing 12 months, it's now $4.2 billion. So they're really racking up the debt there, and with that, the net debt to free cash flow has really gotten out of whack. 2021 was not a bad year, 4.9, but everything after that's been pretty cruddy. It jumped up to 17.3 in the following year. And even after that, it's considerably higher, upwards of 30, which is insane. And this coincides with the decline in free cash flow right here. So really not too surprising to see that ratio jump up even higher. And then obviously in 2024, the free cash flow is negative. So naturally the net debt to free cash flow is going to be negative as well. So I don't know, guys, when you pair the consistent increase in debt with the, consistently declining free cash flow, it just spells trouble. That's just not something you want to see in the businesses that you own. And then looking at the dividend stats, this one is going to have the lowest yield of the day. The yield for Weston is only 2.6%, so considerably lower than the other two companies, but as opposed to the other two companies, Weston has still consistently grown their dividend year in and year out since at least 2017 here, and quite aggressively. The 5-year growth rate's about 12%. But here's where things start to get a little bit questionable for me when it comes to their dividends. So as we've seen already, in 2024, the free cash flow was negative. It was below zero, and the 2 years prior to that, it was not in great shape. The free cash flow was also very low in those years. However, Weston thought it would be a prudent idea to increase the dividend almost 19% in 2024, coming off of a poor year of free cash flow going into a year of negative free cash flow. Now, as I'm sure you can imagine, with the declining financials, that's going to push the payout ratios up and up and up. And we can see really since 2021, look at that steep trend upward. In 2022, it was above 100%. In 2023, it was above 150%. Obviously, not a good situation in 2024. And in the trailing 12 months, according to this, it's sitting at 240%. And simultaneously, while they are still increasing the dividend, almost 18% just this last year, while they are still doing that, the company, remember, is still racking up debt on their balance sheet. Now, I don't know. Let me know what you guys think about this in the comments, but I'm interpreting that as this company, at least in part, is using the debt that they're adding to the balance sheet to pay an increasingly higher dividend. We'll see what happens with this trend, but it's not great. And once again, I've said this a couple times already in this video, but there's only so long that a company can keep this up. At any rate, guys, as I'm sure you can imagine, I have no interest whatsoever in owning any of these companies. And if you want to learn about a few more stocks that I'm also definitely staying away from and suggest you do the same, then check out this next video right over here. In this one, guys, you'll learn about 3 more dividend stocks that also look like pretty solid dividend cut candidates. The companies over in this next video are showing very similar signs and very similar red flags to the ones that we just looked at. So click right over here to check those out, and I'll see you in the next one.